Welcome everyone to the financial risk management video. We will be talking about risk management. Remember, we are talking about risk and risk to be associated with the loss of money if you don't take proper precautions. Risk management is a process. Remember, what is it we are talking about? It is the risk that the corporate takes around it. So, how do we manage this process? We will be defining it, measuring it, managing it, and monitoring it. Hence, for this particular club would be notified in this side of the screen altogether. Remember, we are trying to define what is we are talking about risk. How do we measure risk? Probably if try to manage risk and the monitoring of it that goes around here. So financial risk, does it matter? Definitely, because if you don't manage risk, you stand to lose your money. Why and when should we hedge? Big question that we need to understand. Why and when should we hedge? Whenever we are taking a whenever we are trying to manage our greed, risk is what we are looking into it. Why should we hedge and how we should gauge the exposure? Financial risk management must be tied to the company's business thereby. Market definition. Did I say define? This is what we are saying. Define, measure, manage, and monitor. That is what we will be talking around it. So, three views of market risks. One is transaction, during transaction, balance sheets and portfolio, and economic risk thereby. Three views. We are talking of transactions, balance sheet, portfolios, and economic risk per se. So transaction exposures are directly related to portfolio. Portfolio exposures are directly related to economic exposure. So if economy goes down here and there, probably your portfolio returns will also go here and there. And there is also always a transaction risk in case the transaction doesn't happen and your money seems to be lost in the transit. Isn't that a wonderful risk to be avoided? Yes, now we talk about measurements. Did I say we are switching it from here to this slide? So where are we now and where do we need to go? Where are we now and where do we need to go? That is what we are looking into it. As in the volumetric, the notional amounts, the amount of few million that we are risking. In case if it's a corporate, it's few hundred billions, it might be there. Duration or the present value of one, as in the linear risk. So if we are putting in the money for an investment for a business is what is the return that we need to accrue upon it. Remember, the return should be more than what we are putting in the money as of today. The present value, it should be more than the present value. So linear risk measures, swap, bond equivalent. Option sensitivity measures, non-linear risk measures, delta, gamma, vega, theta, RHO. No aggregations of risk measures across assets and classes, perhaps instruments, if I may say so. This is option sensitivity. Then we have the simulation, as in the limited market scenario. That could include market correlation, reprice portfolio, parallel and non-parallel curves shifts, aggregate portfolio risk per scenario as on when on basis. Value at risk is distribution of market moves and portfolio values. Include market correlation, repricing portfolio, aggregate risk measures with confidence. This is what we are looking every now and then. So yes, what about the amount of money that we are putting in? What is the risk of the present value that we are going to go around it? What about the sensitivity of the measures? How perfect the measures are around it? And probably can we have a pilot study before actually putting in the money, because this is the value that we are trying to put in a risk. So yes, we need to think it twice, once, twice, and a number of times. And overview of corporate value added risk as the concern. So we have businesses. Remember, business one, business two, business three, or product one, product two, product three, or location one, location two, location three. Talking about transactional databases, portfolio databases, projected revenues and projected operating costs. This is what we are looking for it. And the alternatives, the alternative, can we have the base rate currencies, the volatilities, the correlations, the historical rate, the discrete situation? Now what happens if we put it in the interest rate as in model 1, or in equity as in model 2, or in commodities as in model 3, or in currencies? They will also give me a return, right? So which makes a sense? If this is more than this, probably you should invest in the business. But if this is more than this, probably you should be investing in the fixed currencies or equities where you are allowing your currencies to be monitored or to be executed by somebody else to generate more return. What are we looking into it? We are only trying to increase a cash flow. Remember, at the end of the day, it's a uh, bell curve. It's a normal curve that goes around it because this is what we are, which is impacting our earnings. So as an individual, you should put something in your business, something in your equities, something in your commodities. So you are trying to balance your risk to the best optimal flow and optimize your cash flow distribution thereby. So analyzed, this is what we said, defining, measuring, and now we are talking about managing. Analyze the management activities exposures. We are talking about investigating opportunities for natural offset. I have just given you business one, two, three, and then we have investment in commodities, equity, stocks, or fixed deposits. Evaluating alternative hedging techniques. So we have investing in investing opportunities as in multi-currency borrowing, investing, currency of invoices. Evaluating alternative is all about financial instruments such as forward, future, swaps, option. Then we have cost and benefit analysis, as in expected out of pocket cost, benefit, risk, potential strategies. And then we have the strategic alignment according to the overall corporate policies, acceptable from accounting and regulatory standpoint. This is what happens. Now, if you look into it, what is happening around here? We are talking about corporate exposures. What are the hard targets and what are the soft targets? Let's see, the economic exposures is what we are talking around here. Yes, economic exposures, this is a soft target. Then from the budgeted trade targets, remember, as we go up from budgeted trade flows targets to accounting information to portfolio system to current trades, as the case might be. What are we doing it? We are moving from a soft flexible targets to a hard fixed target. This is the inflexible commitment, and this is my flexible option as and when it is going around it. So this to be taken as far as manage is concerned. Now let us understand what to monitor and what not. Most used instrument hedge identifiable exposure. We still into those managed constraints altogether. We are talking about the futures. We're talking about the futures, swaps, over-the-counter options, exchange options, structured derivatives, hybrid debts, equity, commodities, interest rate, foreign exchange, and look at the quantum of money that can be allocated a number of ways that can come across with it. This is my most used instruments as on when on basis. Depending upon the interest rate in which year, the swaps you need to put it around, the futures if you look around as on when on basis. So market views impact incorporating foreign exchange. FX is foreign exchange hedging decision. After the timing of the hedges, 11% is done on a frequent basis. 61% probably little, very less or sometimes. Similarly, for altering the size is around 12%. Actively taking position is around 6%. Now, if you look into it, the foreign exchange hedging positions, if you look, you are taking only very less amount of time as far as hedging is concerned. When probably more frequently you are taking a bit of a higher risk. The sources of corporate financial risk. We have the uncertain markets, we have the uncertain exposure, we have mistaken views and wrong risk measurements method as and when on basis. Now, this is a risk that comes around here. What are we looking at? Uncertain market, uncertain exposure, mistaken views, wrongly risk measurement methods thereby. And this can all put you into doldrums. This can all eliminate the fund that is in your kitty. So you have to be very prudent when you take a risk. Monitoring and control. Monitoring implies performance measurements. The last steps is what we are talking about. It implies performance measurement. Performance measurement is a science of attribution. Performance measurement requires a benchmark. Surprise requires reassessment and responses thereby as on when on basis what you need to do it, how you should be going ahead with it. This is what every person needs to answer. Evaluate the management reporting risk and the management monitoring process. We are talking about the senior management. What are they looking into it? They are looking into the independent risk and the management of audit, internal audit, in terms of limits and benchmarks, in terms of financial products information. Management reporting and focuses, performances, measurements are necessary to identify the problem with the current risk management strategy. So, as a senior management, you should always put keep an eye on the things that the ways are going around the way the things are going around it. You should also appoint independent risk auditors. You should see what is your exposure is information, your financial product information, and be at the breast of the things so that you can come up at the right junctions to take appropriate decisions. With this, I come to an end of this video. Thank you for watching it.